Hello friends, welcome to the NISHCHAY Series of BFM. In NISHCHAY Series, we are covering MCQs plus case studies. Today, I will be covering mainly derivatives, the most difficult part. I will be covering few numericals and few objective questions. These numericals are very tough. Frankly, they are very tough. Watch the video till the end. Share it with your friends. Like the video. Okay? Watch the complete NISHCHAY series for all the subjects. Not only for BFM, all the subjects. Because here you are getting free numericals, objective questions for all these questions, all the subjects as such. Then why not to use it? Isn't it? So watch it completely. Watch this video also. Like this video. To the channel and like this channel. Huh? Now one thing let me clarify regarding this derivatives. Derivative is not an earning instrument. Very basic rule. There are two things always in any investment. Okay? There are two things. One is either you invest to earn or you invest to protect. Protect. Either you invest to earn or you invest to protect. You'll say, what do you mean by this, sir? I always invest to earn only. Okay, agreed. You invest to earn. Okay. What? Mutual fund? Earn. FD? Earn. Right? What is there in protection? Where do you protect? Insurance. Why do you invest in insurance? Insurance. To protect. Derivatives, call put, derivatives to protect. This is also called as hedging, hedge. Protect means hedge. Okay. Although you all sell insurance nowadays as an investment tool, returns, huge returns. Wrong. Insurance is not an investment tool. Although it has a flavor of these mutual funds nowadays. Many of the bankers will go against this. No, sir. We are selling insurance, endowment plans, ULIP, huge returns. I know everything. Okay? Huge returns. Insurance is actually a term plan. Very simple. Term plan is an insurance. Remaining anything you do, let it be your endowment, let it be your ULIP, nothing. If you want to get returns also in this, do one basic rule. I'll give you. Take this tip from me. Invest in term plan, in insurance, and then remaining money which you want to invest in mutual fund SIP. You'll earn a lot. Equity, obviously, not data, equity. So move on. So which of the following, point over here was derivatives are for protection, hedging. They are never for earning. Kindly note this. Many of the guys in the stock market who deal in derivatives, they go there for earning using derivatives. Totally wrong. It is for protecting. Okay, hedging. Which of the following are permitted? OTC forex derivatives in India. Permitted OTC. Foreign exchange option, foreign exchange future, foreign exchange forward, all of the above. Permitted OTC forex derivatives. OTC means what? Over the counter. Over the counter. OTC means over the counter. That is OTC. Over the counter. So which of them are permitted OTC derivatives? Now, give me in the comment section, let me see. Many of you will answer it, all of the above. Okay, many of you will answer it, all of the above. Why? Because I've heard about derivatives, I've heard about options, I've heard about futures, I've heard about forwards. So this will be the answer. Kindly note, we are talking of OTC. This is the only answer. These two are exchange traded. ETC you can call it, ETC. One is OTC, second is ETC. Exchange traded. Okay. So, this is ETC, this is OTC. Only forwards are OTC. What is the difference between OTC and ETC? In OTC, there are only two parties. two parties. Which are the two parties? Buyer and seller. Buyer and seller in OTC. Okay. Whereas in ETC there are three parties. Buyer, seller and exchange. Exchange is there. Okay, that is ETC. Exchange traded. Got it? So that's it. Next. Very important one now. Let's see. An investor owns 10,000 shares worth rupees 50 each. So let's call rupees 50. Okay. Rupees 50 each. How put options can be used to provide the insurance against decline in the value of the investor holding? Very, very, very important. This will give you the basics of derivatives. What did I say? Derivatives are for hedging. So this will give you the basics. Okay. Kindly note. If I am long, here I'll give you the strategy only. Simple strategy. Whenever you are, there are two things. One is commodity. Commodity. Now what do you mean by commodity? Commodity can be dollar, commodity can be gold, commodity can be agri commodity, anything which is traded in the market. It can be natural gas also. And second is derivatives. Derivatives. Okay. So whenever you are long on any commodity, long means what? Buy now, I'll write it over here. Buy now, BNSH. Buy now, sell later. BNSL. Buy now, sell later. That is long. You know BSNL now? BSNL. So remember, just reverse this. BNSL. Buy now, sell later. That is long. Whenever you are long on any commodity, why are you long on any commodity? Because you expect the rate to go up. That's why you are buying. Why do you buy gold? Or why do you buy shares? I'll buy it. When it will go up, I'll sell it. BNSL. Whenever you are long on any commodity, always buy the put derivative, put option. Okay? And whenever you are short on any commodity, short. It means what? SNBL. See, N and L remain the same. Only B and S change. Sell now, buy later. This you buy short when you expect the market to go down. When you expect the market to go down, then you will be shorting in that case. Shorting is allowed in that case. Okay? Whenever you expect the market to go down, and whenever you short any commodity, you will buy a call option. And that is what the question is. How put option will help? Here, the customer is owning 10,000 shares. So what is the position of this customer now, long or short? You tell me in the comment section. What is the position of this customer, long or short? Long. So customer is long over here. If he is long over here, he should buy the put option. So how will it help? Now this put option can be for 1 day. It can be for 1 week, 1 month. In India, we allow up to 3 months. Okay. In commodities, some commodities they allow up to 1 year also, depending on commodity. So let's look at the solution. Investor should buy 100 put option contracts. Here, this is 100 is the notional number. You can make this 1000 also. You can make this 200 also, anything. 100 put option contracts with the exercise strike price of 50 each. So, strike price is 50 only. Now, he is buying put. In put, what happens? Whenever the market goes down, okay, let me explain you that also. Whenever the market goes down, okay, whenever the market goes down, your put option increases. The premium, we always pay the premium. The premium on the put option increases whenever the market goes down. So here what will happen, if you buy these 10,000 shares and they start going down, so you lose in this, obviously you lose because your price is lower. But this put option will go on increasing. So that will increase your money, or that will reduce your loss. Okay. Similarly, reverse over here. You are short. So you expect the market to go down. But if it goes up, then this call will increase. Okay. Simple logic, clear? So now, investors should buy 100 put option contracts with an exercise strike price of 50. So strike price is 50. Expiration date 4 months. Now this can be 4 months or your holding period. Up to the time you wish to hold that shares or whatever it is, shares. Okay. Suppose if I wish to hold those shares for 1 month. Why should I buy the put for 4 months? I'll buy it for 1 month only. Right? If I want to hold the shares for 1 week, why should I buy the put for 4 months? I'll buy it for 1 week only. Depending on your holding position. Okay. So you should buy 100 put options with exercise price of 50, strike price 50, and duration of 4 months. If you are planning to hold it for 4 months. At the end of the fourth month, the share goes less than 50. If the share becomes less than 50. So investors should exercise the option and sell the share at 50. So whenever you have a put option, the premium will go on increasing. Whenever the premium goes on increasing, you will earn in that. And also, whenever you buy the put, what do you mean by this? The put option is for selling. You are telling that other guy that I will sell you the shares at 50. But if tomorrow the share value goes to 45, then also your contract is at 50. That guy has to purchase it. So that's why you'll earn in this. Okay. So that is the hedging. That's why I said derivatives are for hedging. Which of the following are the features of the over-the-counter trading? Over-the-counter OTC trading. Bank treasuries and corporate customers use OTC for forward, futures and swaps. Okay. Next. OTC products are mostly used for hedging underlying risk. Underlying risk. You want to hedge it. There is an absence of counterparty. There is an absence of counterparty in OTC products. Think on it. Which of them is correct? Yes. Do we use OTC for forward, futures and swap? Do we use it for that? Forward, agreed. Forward we use it. Futures. Do we use futures? Futures are not this. Futures are ETC, exchange traded products. So actually, this future I'll remove it. Futures I'll remove it because future is the exchange traded product. Future is not a OTC product. Over the counter, it's not a OTC product. There exchange is involved. Okay. So let's take two only, forward and swaps. Swap is also OTC product. In swap, what happens? There are two legs in swap. Kindly note. For those who don't know, see this. Swap has two legs. Fixed and floating. Floating. Okay. This is swap. Means what? We are having one numerical also. I'll take that numerical. I'll take this. Okay. So fixed and floating. I'll give you a simple example. Suppose if I take 1 lakh rupees from you. Okay, let me show you. I'm taking 1 lakh rupees from you. 1 lakh. See, I'm taking and investing. Two legs are there. Invest. I'm taking 1 lakh rupees from you. 1 lakh. At what rate? I'm taking at 7%. So it means, what does it mean? I'll have to give you 7% rate of interest at the end of 1 year. So 7,000 I'll have to give you after 1 year. Compulsory. So this is fixed leg. Fixed. Now what do? I invest this money 1 lakh in, let's say, stock market. Stock 1 lakh. Now what will happen in this? 1 lakh I have invested in stock market. Now this stock market can give me returns of 50%, 100%, 200%, or 0%, or minus 100%, anything. So do I have the fixed returns over here? No, floating. So one leg is fixed, other leg is floating. That's called as swap. We are having the numerical on this. So bank treasuries use this OTC for forward and swaps. True. OTC products are mostly used for hedging the underlying risk. That is also true. Hedging. Okay. See here, derivatives you are talking of. Derivatives, let it be OTC, ETC. They are used for hedging only. There is the absence of counterparty. Now this is not true. Why? Because here there are in OTC product, just now I told you there are two parties, buyer and seller. So two parties are there. In ETC there are three parties, buyer, seller and exchange. So counterparty is there. Counterparty risk is not there in ETC. Here, note the difference. Counterparty is there in OTC. Counterparty is there in ETC also, exchange traded. But counterparty risk is not there in ETC. Okay. So the answer over here is what? 1 and 2 are correct. Third is wrong. So the answer is 1 and 2. Okay. This is the answer, 1 and 2. In case of derivatives, rising interest rates. If the interest rate goes up, affects the long position in the portfolio favorably. If interest rate goes up, the portfolio, the long position derivatives will be affected favorably. Second, affects the short position in the portfolio favorably. Does not affect the derivatives in the portfolio, both A and B. Think. Some thinking part needs to be done. Yes? If the interest rate goes up, what happens? Let's say, see this. Interest rates go up. Interest rates go up. Then what happens? The price of the bond, price of the bonds generally goes down. Okay? So if you are having a long position, your prices will go down. So it will affect favorably if interest rate goes up? No. It will affect unfavorably. Wrong. It affects the short position in the portfolio favorably. Yes, that is right. Why? Because what do you mean by short? Short means sell now, buy later. I am selling it right now at 100 rupees. Now prices are going to drop. So I'll buy later at 90 rupees. Isn't it? So this is right. Affects the short position in the portfolio favorably. Right. Okay. Which of the following statements regarding over-the-counter derivatives is incorrect? Now you want OTC derivatives as incorrect. Incorrect. Okay. It is a decentralized trading market used by small companies. You want incorrect. Focus. You want incorrect. Okay. It is a decentralized trading. Decentralized means what? Each bank is doing it differently. Each bank is having its own method. It's doing it differently. So is it true? Yes, it is true. It is a decentralized trading, right? Although we have this NDS OM nowadays. NDS OM is there where you have to input the deals. But there also you have to just input the deals. Okay, just for reporting purpose. Compliance. Trading takes place during the fixed exchange hours. Fixed exchange hours. This you have to think. Your bank is open up to what? Your bank is means derivatives between the customer and the bank. OTC, not related to your market. OTC between you and me. Is it related to fixed exchange hours? Think. OTC doesn't have a specific physical location. Instead, persons involving in trading directly negotiate over over a communication network such as telephone. You want the incorrect one? Huh? Think, never forget the main question. Okay? So, do they negotiate on telephone in OTC between the banks? What happens? Do they negotiate on telephone? Yes, they negotiate on telephones. This is true. Okay? This is true. Now you'll say, sir, what, so much risk then? Yes, risk is there. But nowadays we have recorded lines. Everything is done on recorded line. But then also risk is there. Bonds and currencies are traded in OTC. Obviously, what should else be traded? Right? In OTC products, that should be only traded. So this is also true. So what is false then? Everything is true. This is true. This is false. During the fixed hours, nothing fixed. Up to the time you are there in the bank, up to the time you are working, deals can be fixed at 11 p.m. at night. Because after all, it's you and a customer. You get the authority, you do it. Isn't it? Got it? Everyone? Next one. Now these are two numericals. This is a swap numerical, swap. Very important one. Huh? Suppose two companies A and B both wish to borrow 1 million. Both wish to borrow 1 million rupees for 5 years, and rate of interest is the following. So rupees 5 years. See, both wish to borrow 1 million, both A and B, for 5 years. Now what is the ROI they are paying? See, this is what they are paying. Companies are ready to pay. Companies are ready to pay. I want 5 million and this is my rate. Okay. So in fixed rate, companies are ready to pay, means company A is ready to pay 10% per annum. And company B is ready to pay 11.2% per annum. So company B is paying higher rate of interest in fixed rate. What about floating? 6-month LIBOR plus 0.3%. Company A. Company B, 6-month LIBOR plus 1%. Again higher. Means company B is paying higher rate of interest than A. A wants to borrow the floating funds and B wants to borrow the fixed interest funds. So A company wants floating, B company wants fixed. Okay? Clear? Clear the terms up till now? This is a swap example. Let's move on to the question. This is a case study. First question is this. This is a case study. Now let's move on to this case study. Who has lower rating than the other from the given data? Who has lower rating? You think, logically you think, who has lower rating? Does A company have a lower rating or B company has a lower rating? Think. Yes, think over it. Who has a lower rating? A or B? Who is giving a higher rate of interest? Why? Okay, let me ask you simple logic. You have nationalized banks and you have cooperative banks, right? Who gives higher rate of interest on FDs? Nationalized bank do give higher rate of interest? No. Cooperative bank gives? Yes. Private bank, private NBFCs. Why? Because people are not going to them. In nationalized banks, everyone wants to keep the money safe. So nationalized bank will say, you come or you don't come. I don't care. Of course, that is not the right way, but general logic. So that's why the one who is very safe will give lower rate of interest. Who is giving higher? B. So who is having lower rating? B is having lower rating, A is having higher rating. Logic. See this. B has lower rating than company A since it pays higher rate of interest. Okay? In both fixed and floating. Got it? What will be the fixed interest swap between the two companies? Fixed interest swaps. You want fixed interest now. Think. Fixed interest swaps. Swap means what? the difference. Here the swap will be like this. A wants fixed rate and B wants floating rate, right? B wants to borrow at floating rates, right? So what will happen? A wants to borrow at fixed rate, B wants to borrow at floating rate. So they will exchange, isn't it? They will exchange. So it can be like this. The difference, they will exchange some stream, fixed amount of payment, and the difference will be like this. In the end, B will pay to A 11.2 minus 10 because B is paying extra rate. So they'll adjust this 10% base and 1.2% extra B will pay. So same logic will be applied to this also. See this. Next, net will be what? B will pay to A, B will pay A. A difference of what was that? 11.2, no? 11.2 minus 10. Pay A 11.2% minus 10%. So 1.2%, right? This is what fixed rate will be, and floating rate will be similar. What is the difference? No difference. 1 and 0.3, 6 months LIBOR is same. So B will pay A, okay, a difference of B will pay A. Again, B will pay A, okay. What will it pay? 6 months LIBOR, 6 months LIBOR, that will not get cancelled, huh? You'll think now, otherwise 6 months LIBOR cancelled, only 0.7% will be paid. No, 6 months LIBOR plus this difference, 0.7%. Okay? This difference will be paid. So this will be the swap between the two. Current stock price is rupees 49. Another one, next numerical. Current stock price is 49. 3 months put option with a strike price is 48. A strike price of 48. Premium is 3.9. Understand the problem properly. Today, say this. Spot, we'll call it spot. Spot, and next is forward. Okay? Forward. Okay? What is the spot given? 49 rupees. Price of that stock is rupees 49. Okay? What is the strike price of the put? See this. Put means what? You are expecting the market to go down. Okay? So 48. So put strike price is, strike for put is 48. 48. Okay? Premium paid is 3.9 rupees. 3.9 premium. So I am paying this premium right now. 3.9. 3.9 rupees per put option. Okay? You invest 9,800 in stocks. So what do I invest over here? I invest, what is the amount? 9,800 in stocks. So investment is what? Invest 9,800. So how many stocks will I be able to buy? 9,800 upon 49. 49, not 48. 48 is the forward price. Okay? 48 is the forward strike price. Future price, you can call it options price, put price, anything. But this is the stock price. So 98 divided by 49, roughly 200. So 200 stocks I will buy. Okay? So now let's look at it. How many stocks did I buy? Stocks. 200 I purchased. 200 into what? 49. That much I invested. So how much was gone? 9,800. This much is gone, right? And 3,900 in put. I am investing 3,900 in put also. So now in put, how much have I invested? 3,900. So 3,900 divided by 3.9. How many puts will I buy? Divide this. So 3.9, then 0, 39, 13, 100. 100 puts, I think so, yeah. 100 into 3.9. Right now? Or 1,000. 1,000, I think so. Yeah, 1,000, correct. 1,000 into 3.9. These many puts I will be able to buy with 3,900. So it will be net 3,900. So how much have I invested? 9,800 and 3900 net investment. What is the amount I am investing right now? 0. 9 plus 8 is 17. 9 plus 4 is 13. So this much I have invested. So this much is out, minus. This much is minus. Okay. Now forward in future, what happens? The price of the stock rises to 60. So now stock price, future. Okay, future. What is happening in future? Stock is rising to stock. Stock is rising to, how many stocks were there? 200. See this. You are able to see this? Stocks were there 200. 200 into, what is the new stock price? 60. So 60 into 200. So what is the answer? 12,000. So this much is in plus. These all are out. What about the put? Put. How many puts I had? 1000. 1000. And what is the price? 1.95. 1.95. So it is, multiply this, 1950. This is also in plus, because this is the price of my put. I can sell it. So now what is the answer? 12,000 plus 1950. So 14,000, 13,000, 1150, 1311, 1150, right? 50. Or something wrong? Yeah, correct. 0. I am very weak in this. 1, this is 3. Okay, 12. Yeah, 3 over here, 9 over here, 9. Very weak here. You do it on the calculator here. Okay. So 50, 0, 5, 0, 9 over here, 9, and 2 plus 1, 3, 13,950. Okay, this is the problem. 13,950. Okay. So how much is in? 13,950. How much is out? 13,700. Find the net gain or loss. Gain. How much? 7, 8, 9, 250. So gain of 250. Okay, this is your. So the final answer is net gain 250. Now important point which you should note over here is derivatives are for hedging. I told you in the initial part also. Derivatives are for hedging only. Hedging means reducing the risk. Derivatives are always for reducing the risk. Kindly note, there are 3 words in BFM. Very, very important. Leverage, hedge. Okay, hedge. And third one is arbitrage. Okay, this problem was for hedging. Okay, I am investing in stock as well as in the put. Okay, this was for hedging. Hedging means reducing the risk. Leveraging means taking more risk. It's simply reverse. Okay, leverage means taking more risk. And arbitrage means buying in one market and selling into another in a short span of time. Okay. So that was it for today. Now before going, join the crash course batches immediately. How to join them? Let me show you. Go to Adda 24/7. Always go through the app. In the app, you are getting 1% extra using the coin system. So definitely download the app first and then go for it. How to join the batches? Look at this. CAIIB crash course. Join this crash course immediately. Okay. Ebooks, mock tests, online live classes, recorded sessions. If you miss out the live classes, you can get the recorded sessions also. So join this ASAP and look at the discount part. Click on buy now. Put the code Y432. Y432. Enter. Look at this. 79% discount you are getting plus 1% extra using this app. Download the app. That's what I'm saying. So 80% discount you are getting. See, this is the best available right now for you because exam is just near now 1 month roughly, isn't it? So you can join this and clear the exam in single attempt using this. Okay, join the crash course ASAP. Bye.